Hey guys, do subscribe to the channel if you find our content useful so we could keep putting out videos for the less privileged. So in this video, we're going to be looking at how a sale affects the financial statements. So going from our previous example, let's presume you've got a pizza store that sells a pizza for $10 each. Now let's presume that a customer's called you on your phone and said he wants to order a pizza. Essentially, your net sales has gone up by $10 because you've sold an extra pizza. Now, because the customer's called you on the phone and he's not paid you for the pizza yet, that $10 goes back into your accounts receivable. So that's money you have yet to receive, right? It's deferred. Now, you've made 5 pizzas for the day and you've managed to sell one of those pizzas. So you essentially subtract that $10 from the inventories because you're down one pizza. You've sold it out. Now, let's presume that the order's been given out, you've delivered it, and the customer's actually paid you the money back. So what happens at this instance is, let's pick a different color. Right. So what happens in this instance is your accounts receivable has been moved up into cash receipts. So your accounts receivable has moved in and you've got a plus 10 on your cash receipts. If you can remember the cash flow video that we put out, your cash receipts are basically money inflow, so the money that comes into you. $10. Now, again, you've made a sale and the cash receipts gone up by $10. This would again translate back into your retained earnings. So you've got an additional 10. Your business has made an additional $10 profit, and it also goes in to your shareholder equity. So you've got an additional 10 coming in to your retained earnings and your shareholders equity. So let's do a quick recap. So if you've got a sale on credit, which is in this instance the customer ordering it but not having paid for it yet, the first thing that's going to happen is your net sales is going to go up. So you've got a additional in net sales, and that gets shifted to accounts receivable. So you've got a spike in accounts receivable as well. That's money that's yet to come. Now, let's presume that you've actually processed that order and you're going forward with it, so the product value changes. Product value. And all that basically means is you take one away from the inventory, so there's a subtraction in the inventory. And that then means that there is an addition in the cost of goods sold. Keep in mind, this is before you get paid. Now, once the pizza has been delivered and the customer's paid you your money back, so you've got your customer paid. Now, once the customer pays, again, it moves from the accounts receivable section and it's a gain in cash receipts. So there's it moves from accounts receivable and that goes on to an addition in the cash receipt. That's money that's coming into your wallet. And of course, the cash coming into your account means that you've had a bump up in the earnings that you made, so that is a plus for the retained earnings. So let's say and your net income.